Hello and welcome to this webcast on IFRS 16. This is the third in a series of webcasts we'll be doing over the next couple of months following the recent publication of the new Leases standard. Today we'll be talking about the requirements in IFRS 16 relating to the definition of a lease. I'm Catherine Donkersley and I'm joined today by my colleague Sarah Geisman. Sarah worked on the Leases project for the last 3 years and during the course of the board's deliberations on the definition of a lease has talked to many entities about their different lease contracts. As we talk through the IFRS 16 requirements in respect of the definition of a lease, we'll include practical examples to demonstrate the things entities need to be thinking about in applying the requirements. Just to note before we start that, as always, the views presented in this webcast are those of myself and Sarah and don't necessarily represent the views of the board or the IFRS Foundation. This slide summarises what we'll be talking about today. There are 3 parts to the webcast. Firstly, we'll spend a good portion of the webcast talking through the definition of a lease requirements in IFRS 16. This is an area in which the new standard contains a lot of application guidance and illustrative examples, and we'll go through that in detail. We'll focus particularly on those elements of the definition of a lease for which some lessees might find they need to make judgments. These relate firstly to assessing whether a contract has an identified asset, and then to assessing whether the customer has the right to control the use of that asset. In the second part of the webcast, we'll look at how the requirements on the definition of a lease in IFRS 16 differ to the previous requirements that were contained in IAS 17 and in IFRIC 4. Here we'll identify the practical examples of where any differences in outcomes might arise when IFRS 16 is applied. Finally, we'll look at what entities will need to think about when they have contracts that contain multiple elements, both leases and services, and how they are required to deal with those contracts when they apply IFRS 16. So starting from the beginning, you can see on slide 3 the definition of a lease as it appears in IFRS 16. So Sarah, before we go into the detail on any particular element of this, perhaps you could summarise the definition of a lease at a high level, maybe focusing on the key ways in which it differs from a service.
Sure. So as you can see on the screen, a contract contains a lease that conveys the right to control the use of an identified asset for a period of time in exchange for consideration. The key distinguishing factor that makes leases different from services or other executory contracts is that when there is a lease, the customer obtains the right to control the use of an identified asset. At the start of the lease, the supplier makes the asset available to the customer, and after that, the customer controls that asset. The customer is the one making the decisions about how to use the asset. That differs from a service because in a service, the supplier is the one making decisions about the use of the asset. The customer has just agreed to receive a particular output from the supplier, and the supplier is the party making the decisions about how to use its assets to produce that output. In light of that difference, the 2 key pieces of the definition of a lease in IFRS 16 are those you can see highlighted on the screen. The contract must depend on the use of an identified asset, but not only that, the contract must also convey to the customer the right to control the use of that asset.
And to be clear, it is the case that both of these things must apply. So the contract could depend on an identified asset, but if that asset was controlled by the supplier, then it still wouldn't contain a lease?
That's right. Whilst a service contract might depend on the use of an identified asset, the supplier would always retain control of that asset. That is, the supplier would decide how to use the asset to deliver the service. In this case, all the supplier has committed to is to provide the service, not to transfer the right to control the use of the underlying asset to the customer. There are a few examples in the illustrative examples to IFRS 16 that demonstrate this point. One example is a customer that enters into a contract to purchase shirts from a supplier. The supplier has only one factory that can produce these shirts, and so the factory is effectively an identified asset. However, there's still no lease because, in the facts and circumstances of the example, the factory is controlled by the supplier and not by the customer. The supplier makes all of the decisions about how to use the factory to produce the shirts, and can also use the factory to produce shirts for other customers. All the original customer gets is the end product, the shirts, and has no control over how the factory is used to produce them. The customer makes no decisions about how to use the factory over the period of the contract. So in cases like this, there can be an identified asset, but there isn't a lease.
Great, thank you. So in a moment, we'll talk through the detail on those two key pieces you've identified. But before we do that, perhaps it will provide useful context for listeners if you could talk about whether you expect the definition of a lease to be a complicated area in IFRS 16. The definition of a lease represents the area of the standard where there is the most application guidance and illustrative examples. Why is this?
So in the sense that these requirements are used to identify the contracts that need to be accounted for applying IFRS 16, understanding and applying them is going to be a very key piece of the implementation process for entities. It's also worth noting that the distinction between leases and services is much more important than when entities apply IFRS 16 than it was previously. That's because today, accounting for IAS 17 operating leases is very similar to accounting for services. However, when an entity applies IFRS 16, almost all leases will be recognized on the balance sheet, and therefore the accounting will be very different to the accounting for services. So we know this distinction really matters when applying IFRS 16, and we've provided application guidance and illustrative examples to assist companies in making this determination between leases and services. However, having said that, all the research we performed on this topic throughout the project demonstrates that in the vast majority of cases, the assessment of whether a contract contains a lease is straightforward. For most contracts, answers to the questions of whether those contracts depend on the use of an identified asset and whether the customer has the right to control the use of that asset will be clear from the contract terms. There are, however, a few scenarios for which answering those questions will require the use of judgment, and in those few cases, applying the definition of a lease requirements in IFRS 16 will involve more work.
And is it possible to isolate what those more challenging cases are? Do they relate to particular asset types, for example?
No, it's not really possible to isolate particular asset types where that would apply. Regardless of asset type, whether or not a contract contains a lease will always come down to the particular contract terms in each case. However, while it isn't possible to isolate particular asset types, generally, the more challenging cases are going to relate to cases where decisions about the use of the asset are split between the supplier and the customer. In these cases, it will be harder to work out who controls the asset. We'll talk in more detail about this later in the webcast. So to reiterate, in most cases, whether a contract is a lease or a service will be clear, but ultimately, in applying the definition of a lease requirements, entities are always going to need to consider the individual circumstances of the particular contract they're looking at. As we talk through the requirements over the next few slides, I'll highlight examples we've come across where judgment is needed in applying the definition of a lease.
Let's start then by looking at the requirements on whether a contract depends on the use of an identified asset. Could you summarise the IFRS 16 requirements here?
Sure. There are two ways in which an identified asset might be specified in a contract. First, it might be explicitly specified. An example of this would be if the contract specified a particular asset serial number. Secondly, though, an asset can also be implicitly specified. There are different ways of an asset being implicitly specified, but an example would be if the supplier only has one asset that is capable of being used to meet the terms of the contract. If that were the case, whilst the asset might not be explicitly specified, there wouldn't be a question about what the underlying asset in the contract is. Therefore, it is considered to be implicitly specified for the purpose of assessing whether a lease exists.
So have you come across real-life examples of that kind of implicit specification? What types of asset might that apply to?
Yes, we did come across examples of this. One example might be a power plant connected to a factory. A contract giving the operator of the factory the right to use the power plant could only ever be fulfilled by that one particular power plant, and as such it would be implicitly specified that this is the asset referred to in the contract. Also, the contract for shirts that I mentioned earlier could be another example. If the supplier only has one factory that can fulfill the contract terms, then effectively that factory is implicitly specified as an identified asset in the contract.
So is it the case that if an asset is either explicitly or implicitly specified, then the identified asset element of the definition of a lease is always satisfied?
Well, often that will be the case, but no, it's not always that simple. There are a couple of other things that a lessee needs to think about before concluding that there is an identified asset in the contract. So the first of those, and probably the most significant, relates to the possibility of the supplier in the contract having substantive rights to substitute the asset. If this exists, then the contract would not contain an identified asset and therefore would not contain a lease. A supplier is considered to have a substantive substitution right if two criteria are met, and it is the case that both must be met. One is not enough. The first of these criteria is that the supplier needs to have the practical ability to substitute the asset throughout the contract term. That might be the case, for example, if it has other identical assets readily available and it is easy for the supplier to perform the substitution. The second of these criteria is that the supplier would have to benefit economically from substituting. Essentially, that means the benefits that the supplier would get from substitution would exceed any cost.
And could you give some practical examples of how this works? Maybe circumstances in which a substitution right is or isn't substantive, or some of the factors that an entity needs to think about when making that judgment?
Of course. So I'll run through a couple of the real-life circumstances that we came across when working on these requirements. One thing some companies might need to think about is where the asset will be located during the contract term. For example, often the asset is located on the customer's premises in a way that makes it very difficult or costly for the supplier to substitute the asset. That could be an indicator that a substitution right is not substantive. Another important point to note is that substitution only for the purposes of repairs or maintenance or to replace an asset that is not operating properly would not disqualify a contract from being a lease.
And what would be an example of a substitution right that would be substantive? Something that would mean that there's no identified asset.
So a substantive substitution right would be one where there is a clear reason for the supplier to substitute. You would expect the supplier to substitute because it's going to benefit economically from that substitution. Where a substantive substitution right exists, we think it will be pretty clear. One example of a substantive substitution right that is discussed in the illustrative examples is where a supplier has contracted with a customer for the transport of a specified quantity of goods using a particular type of rail car. The supplier has a pool of rail cars and can use any one of those cars to transport the goods. So even though the contract period starts out with 10 cars being used initially, the supplier could change those cars whenever it wants to. Also, the supplier would have an economic reason to substitute those cars. There would be minimal cost associated with the substitution because the supplier has a pool of rail cars that it can easily substitute. The supplier can use the substitution to most efficiently fulfill all of its contracts. However, whether a substitution right is substantive will depend very much on the facts and circumstances of each particular contract. For example, in the example that I've just talked about, if the supplier did not have a pool of similar cars that could be used to fulfill the contract, and instead only had 10 cars, and if it would be difficult for the supplier to source other similar rail cars, then it would be much harder to argue that there was a substantive substitution right. That's because in these circumstances, it will be harder to argue that the supplier would economically benefit from substituting the assets.
Thank you. And just to highlight for listeners that there are other examples in the illustrative examples to IFRS 16 that focus on assessing whether a substitution right is substantive. Now, you mentioned that there are a couple of additional things that lessees need to think about on identified assets. Apart from substitution rights, what other considerations are there?
So another area that has some specific requirements in IFRS 16 relates to portions of assets. That is, if a lessee has the right to use some but not all of a particular asset, can part of an asset qualify as an identified asset? And the requirement here is that a portion of an asset can be an identified asset if it is physically distinct. So something like the floor of a building, for example, where the right of use held by the lessee is over a part of the asset that can be clearly distinguished from the rest of that asset. An example of where the portions of assets requirements might come into play is something like a capacity portion of a fiber optic cable, where a customer has the right to a particular level of output from that cable, but other customers or the supplier are also getting use out of it. In that case, because the portion is not physically distinct, there generally wouldn't be an identified asset. However, as always, it is important to consider all elements of the contract. For example, if the customer's portion was in fact substantially all of the capacity of the cable, a different conclusion might be reached here. Alternatively, we have come across examples where a lease is over a number of particular fibers which are physically distinct from the other fibers within the cable. In these cases, although only a portion of a bigger cable, these fibers are physically distinct and so are not prevented from being an identified asset.
Okay, so let's now move on to another element of the definition of a lease. Having established that there is an identified asset in a contract, an entity then needs to establish whether the customer has the right to control the use of that asset. Could you summarise the IFRS 16 requirements here?
Yes, of course. So there's two elements to this. A customer will have the right to control the use of an identified asset if, firstly, it has the right to obtain substantially all of the economic benefits from use of that asset, and, secondly, it has the right to direct the use of the asset throughout the period of use in the contract. To be clear, an entity needs both of these things in order to have the right to control as defined in IFRS 16. It's not an either-or assessment. IFRS 16 contains detailed application guidance in respect of both of these elements.
Let's start with the right to obtain substantially all economic benefits. And that's a concept that comes up elsewhere in IFRS and that listeners may be familiar with. Is there anything companies should be thinking about when applying this concept within the context of the definition of a lease?
Entities should keep in mind that the assessment of whether the customer has the right to substantially all of the economic benefits should be considered within the context of the scope of the entity's right to use the underlying asset in the contract. What I mean is, the potential economic benefits associated with the right of use conveyed to the customer are not going to be the same as the economic benefits associated with the entire underlying asset for its entire useful life. For example, if a contract gives a customer the right to use a car, but the contract limits that use to a particular amount of mileage, entities should consider only the economic benefits associated with that amount of mileage when assessing whether the contract contains a lease. The fact that there might be potentially more economic benefits associated with using more mileage isn't relevant because that is outside the scope of the customer's right of use in the contract. So in that case, if substantially all economic benefits associated with using the car up to the specified amount of mileage can be obtained by the customer, then the economic benefit criterion will be satisfied.
And have you come across any examples where this criteria would not be satisfied? In other words, situations where there is no lease because the customer doesn't have the right to obtain substantially all of the economic benefits from use of an identified asset?
Yes, we have. I briefly mentioned at the beginning an example of a contract to supply shirts to a customer in a scenario where the supplier only has one factory that can be used to produce the shirts. That factory would be an implicitly identified asset. If the circumstances are such that the supplier is able to use the factory in other ways during the course of the contract with the customer, for example, to produce shirts for other customers, then it is unlikely that the customer has the right to obtain substantially all of the economic benefits from use of that factory.
Moving on then to the second aspect of the assessment of whether the customer has the right to control the use of the asset, This is whether it has the right to direct the use of the asset throughout the period of use. Could you summarise for us what IFRS 16 requires here?
The key thing here is to determine who directs how and for what purpose the asset is used during the period of use in the contract. If the supplier directs how and for what purpose the asset is used, then the supplier controls the asset and the contract does not contain a lease. However, if the customer directs how and for what purpose the asset is used during the contract, then the customer effectively has the right to direct the use of the asset, and this criterion is satisfied. There is also a third, slightly more complex scenario, which is when how and for what purpose the asset is used is not directed during the contract term by either the customer or the supplier, but instead is predetermined before the contract commences. We don't expect this scenario to arise very often, but when it does, entities will need to look at other decisions made about the asset to see who directs the use of the asset. If the customer has designed the asset in a way that predetermines how and for what purpose the asset will be used, then the customer will control the use of the asset. We would expect this to happen very rarely, but it could happen. One example we are aware of is customers designing things like solar plants in a way that removes any need to make decisions about how and for what purpose the asset is used once the plant is installed. In all other cases, if there are any decisions to be made about the operations of the asset during the contract period, the party who makes these decisions controls the use of an asset. One example of this is a shipping contract, which is sometimes called a voyage charter contract. This is a contract to ship goods on a vessel for only one particular voyage. All of the how and for what purpose decisions about the use of the ship are predetermined in the contract. The customer and the supplier have decided in advance what voyage the vessel will take, what goods the vessel will transport, and the timing of the voyage, and these decisions cannot be changed. The only decisions left to make about the vessel over the term of the contract are the decisions about operating the vessel, and the supplier is responsible for operating the vessel. Therefore, the supplier controls the use of the vessel.
And could you talk about the factors that entities need to be thinking about in terms of making the how and for what purpose assessment? What are the criteria that determine which party has this right?
So when thinking about this, entities need to be thinking about whether the customer is able to change how and for what purpose the asset is used throughout the period of use. If it does have this ability, then it has the ability to direct how and for what purpose the asset is used. At a high level, decisions made about how and for what purpose an asset is used are those decisions made about the output that an asset produces. Where it produces output, when it produces output, what output it produces, and whether it produces output. Now, it is generally going to be the case that there are many decisions made about the use of an asset, and in some cases, these decisions will be split between the customer and the supplier. IFRS 16 requires entities to consider the decisions that are most relevant to changing how and for what purpose the asset is used. The relevant decisions will be the ones that affect the economic benefits that will arise from use of the asset. These relevant decisions are likely to vary from contract to contract and from asset to asset.
Could you give some examples?
Sure. So there are a number of examples of this concept in the application guidance and illustrative examples to IFRS 16. Some examples of decision-making rights that, in the right circumstances, might be the most relevant ones to decisions about changing the type of output that is produced by an asset and changing when or where that output is produced. So in a contract that gives the customer the right to use some retail space, it might be that the ability to decide what products to sell from that space may well be the most relevant decision-making rights. If a contract gives the right to use a piece of manufacturing equipment, then decisions about what the equipment will be used to produce, in what quantities, and to what time frame might be the most relevant ones. Another example would be a shipping example in which the facts and circumstances are different to those I talked about on the last slide. In the cases of what is sometimes referred to as a time charter contract, a customer might enter into a contract that gives it the right to use a specified vessel for a specific period of time, say 5 years. For those 5 years, the customer decides what cargo will be transported by the vessel, where it will sail to, and when it will sail. In this case, even though the supplier operates and maintains the vessel, it is the customer that makes the decisions that are most relevant to how and for what purpose the vessel is used. Because of that, the customer controls the vessel, and so the contract contains a lease.
I think that covers all of the main elements of the definition of a lease requirements and guidance in IFRS 16. So now we'll move on to having a look at how all of that compares to the previous requirements on this topic. Those were the definition of a lease in IAS 17 and the guidance on determining when an arrangement contains a lease, that was in IFRIC 4. The slide that's on the screen now quotes the definition of a lease under both the old and the new rules. The new rules are in the red box, and the old rules you can see in the gold boxes. I think it's fair to say that these words appear to be fairly similar, and listeners may be most interested in what the practical differences between them are. So Sarah, perhaps you could summarise for us how the old and new requirements differ and give some practical examples of contracts that could give rise to a different outcome when the IFRS 16 definition of a lease requirements are applied.
Of course. Starting with how the old and new requirements differ, as you say, the two definitions are similar in many ways. However, the detailed requirements and application guidance underlying those definitions are a lot more detailed in IFRS 16 than they were previously in IAS 17 and IFRIC 4. Ultimately, that's because the definition of a lease becomes a lot more critical when an entity, particularly a lessee, is applying IFRS 16 than it was previously. As I mentioned at the beginning of this podcast, that's because accounting for leases applying IFRS 16 is very different to accounting for services. I'd also add that as part of the due process around IFRS 16, in one of our exposure drafts on the standard, we had actually proposed requirements on the definition of a lease that was nearly identical to the old requirements in IAS 17 and IFRIC 4. However, we received a lot of feedback on that proposal, stating that such requirements would be insufficient to ensure that the definition of a lease was applied properly. There are some existing practice issues around application of the guidance in IFRIC 4, and many stakeholders thought that those requirements might capture contracts that they view as services. There were also requests for us to make the requirements on control consistent with the requirements on control in our more recently published standards on revenue recognition and consolidation. So in terms of what's written, the principles are similar, but the requirements and application guidance in IFRS 16 is more detailed. There are also some changes made to align the concept of control with the concept of control in the revenue recognition and consolidation standards. Moving on then to what the practical consequences of the IFRS 16 requirements on the definition of a lease are compared to before. In short, the differences are fairly limited. The practical outcomes of applying the definition of a lease requirements in IFRS 16 are expected to give the same result as applying those in IAS 17 in the vast majority of cases. Throughout the course of the project, we talked to many entities about their contracts, and in doing so, we did not identify any contracts in which a contract that was entirely a service applying IAS 17 would contain a lease when IFRS 16 is applied. In terms of the opposite, there is one particular scenario that was identified in which an IAS 17 lease could become an IFRS 16 service. That example arises when a lessee takes all of the output of an asset, but does not have any decision-making rights over the use of that asset. Essentially, it relates to the fact that when applying IFRS 16, a lessee obtains the right to use an identified asset and controls the right to use that identified asset only if it directs the use of that asset. This requirement wasn't there before, and it is therefore possible to get a difference here. In this scenario, whether there's a change in outcomes applying IFRS 16 as compared to today would depend on pricing. Having said that, we understand that the scenario giving rise to a change in outcomes is relatively rare in practice, and in all but this case, we do expect that practical outcomes will be the same.
That brings us on to the level of work that lessees will need to do on transition here. We talked about this in the transition webcast, but for completeness, could you briefly summarise? Listeners may be thinking at this point that there will be a lot of reassessing of contracts to do on initial adoption when, in practical terms, not very much is going to change as a result.
That's right. There might have been potentially substantial cost for relatively little benefit here when an entity first applies IFRS 16. For that reason, there is transition relief in IFRS 16, which gives a lessee the option to retain the existing assessment of whether a contract contains a lease for all existing contracts. That is, for all ongoing contracts entered into before the date of transition. If an entity chooses to use this relief, then it can assume on transition that existing leases continue to be leases and existing services continue to be services, and transition its contracts to IFRS 16 on that basis. The definition of a lease requirement in IFRS 16 would then be applied only to new contracts entered into after initial application. Because the differences in practical outcomes are expected to be limited, this will give entities cost savings on transition with little, if any, expected consequence for reported information.
Moving on to the last section of this webcast then. You've already talked about how the definition of a lease is a lot more critical than it was before because almost all leases are coming onto the balance sheet. So that means that separating leases and services in a contract that contains both of them is another important consideration in IFRS 16. Could you talk about the requirements and guidance on this?
Sure. The starting point here is that if a contract contains both a lease and services, then those elements need to be separated and accounted for separately. This is important because there is now a significant difference between how leases are treated and how services are treated, especially on the lessee side. An entity then needs to allocate the consideration for the contract between the different components. How an entity goes about making that allocation depends upon whether it is the lessee or the lessor in the contract. How contract consideration is allocated to different components for the lessor is something that's effectively covered by the revenue standard, because the lessor is, of course, the supplier here. Therefore, IFRS 16 does not contain specific requirements on how lessors should allocate the consideration, but instead sends those lessors to IFRS 15. For lessees, IFRS 16 does contain standalone requirements. And the starting point is that allocation of contract consideration between the components should be performed on the basis of relative standalone prices, i.e., how much would the lessor charge to sell each individual component alone, and not as part of the bigger contract.
So I think that means a lessee needs to base its accounting on how the lessor has priced the contract. Will that always be possible? What if a lessee doesn't have access to that kind of information? It's
a very good question and one that the board thought about in determining the requirements. There's a couple of relevant things in IFRS 16 here. First, a lessee is permitted to estimate the standalone price of components if the information, observable standalone prices aren't readily available. If it does this, it needs to maximize the use of observable information. For example, the price the supplier or other suppliers would charge for the component on a standalone basis are the prices the supplier has charged to other customers. Second, there is an optional practical expedient that a lessee can apply here. Applying that practical expedient means that a lessee can choose to account for the whole contract as a lease, or a number of lease components. In that case, the whole contract would be capitalized on the lessee's balance sheet.
So a lessee has the option of treating all elements of the contract as lease components. For completeness, the practical expedient doesn't give an option to treat the whole thing as a service.
No, it doesn't. A lessee's choices here are either 1, separate lease and non-lease components and account for lease components as leases and service components as services, or 2, don't separate out the non-lease components, instead combine them with the lease component and account for the combined unit as a single lease component. There is no option that permits the lessee to account for any lease component as a service. So to give a simple example, if a contract has total consideration of 100, of which, ignoring any discounting, 90 relates to a lease component and 10 relates to a service component, the lessee could either recognize a lease with total lease payments of 90 and a service for which it pays a fee of 10. Alternatively, it could choose to recognize just a lease with total lease payments of 100. One other thing to mention about this practical expedient is that a lessee chooses to apply it by class of underlying asset. So if a lessee chooses not to separate out non-lease components on one of its car leases, for example, it needs to apply that to all of its car leases.
Thanks very much, Sarah. So we've now talked through the definition of a lease in IFRS 16 in some detail, and also looked at the practical differences as compared to today and how an entity should deal with contracts that contain both leases and services. This final slide notes a couple of links to further information that can be found on our website. The second link, which is to the leases implementation page, summarises all of the work the board is doing to support implementation. Within that, there's some information about the rest of this webcast series, links to previous webcasts, and the full list of upcoming webcasts can be found by following this link. We thank you for listening to our webcast and hope that it was helpful.